Welcome back to Exchange Sheet Capital. I am Rick Ellenbach, your host. Tonight, we're going to do something that I promised myself I would never do. I had a whole agenda. I had another video shot and ready to go. But based on almost 1,500 emails, LinkedIn responses, comments, people asking me, Rick, what stocks are you buying now? Rick, if you had to pick 5 or 3 or 6 or 10, what would they be right now based on the market, based on 2020 and everything that's happening? And I didn't want to do that. It's not that I couldn't, I didn't want to. But I got to thinking, and for one, I looked at YouTube, other YouTube, some of the nonsense that people are putting on in terms of stocks they're looking at and high volatility trading and options for folks who have no business doing it, and people bragging about what they work 15 minutes a day on options and how easy it can be, and then go to them and they'll charge you $1,000 and they're going to teach you. There's a saying for people that play big time money Texas Hold'em that's my favorite. Those who chase straights and flushes come to the casino in limos and leave in buses. And that kind of nonsense is exactly the same thing. Those folks are not tried and true. They will not be here for the long run. Our job is to be here for the long run. Put our money to work so that it makes more money to then move it to work and continue the process forever. So, like when my wife asks me to do something, I do what I want anyway, take a week to think about it, and then do what she asks. That's what I've done for all of those of you who have asked me. So tonight, without further ado, 6 stocks right now. Now when I say right now, I have 6 stocks that I feel will be here for the rest of my life, will be valuable, will continue to appreciate. Some will pay dividends, some will just, go up in value. We're going to pick 3 what I'll call blue chips that are either undervalued or behind their peers that are fantastic companies, and 3 frontier companies that are either mid to small cap companies, companies on the come, that are maybe are already had a run but I think have more in them, or are the future. I'm not going to sit up here and just say, hey, Procter & Gamble and Lockheed Martin, etc. So let's start with 3 companies that are blue chips that I recommend. The first one is Disney, ticker symbol DIS. Look, everybody on Twitter is debating me, everybody that I talk to is debating me about Disney versus the cruise lines. I mean, there is such a difference. Cruise lines, to me, run from them. Don't go on a cruise. I don't understand cruises. When I go to islands and the cruises come in, we run for the hills. I don't understand them. I didn't understand them before COVID. I certainly would never invest in them now. Disney, yes, they have theme parks, and they're bleeding in the tune of billions with a B because of them. They're a multi-conglomerate media juggernaut. They own Marvel. They own the Lucasfilms collection of Star Wars. Their catalog is ridiculous. Disney Plus. I could go on and on in terms of ABC, ESPN, etc. I can't imagine what The Last Dance is going to do, honestly, for the quarterly earnings. It's gotten crushed. It's been down lower than this, and I've been buying this. I was buying at 140. You can bet your ass I was buying at 90. and I'll certainly still be buying at 115. So the year range, 79.07 to 153.41. So right in the middle. You're getting this thing, well, a little, yeah, about right in the middle of what it's been over the past year. Okay? And part of that reason is because of COVID. As of today, at least, Disney World is closed. All Disney functions are closed. We were scheduled to go in September. I'm not sure. I couldn't believe that we'll be going. The earnings per share, $2.97, even with them getting wrecked in the first quarter because of all the parks being closed. When we look at this chart here, this is small company, mid-sized company, large company. Small company, $2 billion market capitalization. So that's market capitalization is simply the amount of shares outstanding times the price of the stock. That's all it means. Value, blend, growth. This is a large cap value. The market cap is $208 billion. It's a very large company. So that's fine. Price to earnings. So the price of the company based on the earnings is 59.88. That's ridiculously expensive. I have it asterisk. They're getting their asses kicked. They're getting crushed. It's one of the reasons we want to buy them, because it's cheap. So the rules that I have to get thrown out when we're in a historic international pandemic. Return on equity is not very delightful, as it were. $5.97, asterisk. Dividend, they had to cut it. They need the cash. They're not broke, but they want to keep that cash. It's smart. They should be cutting dividends. As an investor, I will sacrifice that dividend now so that this doesn't go to 40. Of course, I kind of wish that it would, then I'd buy the hell out of it. My point is, this is okay and it will come back. So the mouse is going to go up. Disney's a massive buy. AbbVie. So we have a media conglomerate and entertainment company. Now we have a biotech company. ABBV, AbbVie. They were a spinoff of Abbott Labs years ago. Now they're on their own. Their price, $89.84. The year range, $62.55 to $97.86. So we're a little bit more on the high side. That's okay. Earnings per share, they're making $5.65 per share. That's very good. Here's that's a large cap blend as well. Market cap $158 billion. Very large company. PE 9.48. What? That's like ridiculously cheap. Price to earnings. So obviously you can see, okay, well this is cheaper than this, but it's way cheaper in future dollars. Forget the price you're paying it now. We've gone over that in earlier videos. We'll go over it again. Dividend yield 5.16, extremely tasty. 5% dividend on a biotech company that's got room to move with a PE at 9. Holy shit, I love it. I'm not going to go through all of the things that it has, but two top things. Immunology launches have been absolutely successful, and they just got cleared to go ahead and purchase Allergan, which was the old Watson and Forest Labs, and they have they have Botox. They have a ridiculous portfolio, which is fantastic. I own the hell out of AbbVie. I bought it at 50. At 70, I had friends that bailed out and bought. I kept it for the dividend and the fact that it's flirting with 90. This is a $130 stock right here. The third is Alibaba, BABA. So online e-commerce is the way of the future in terms of retail. You see all these brick and mortar retail companies going into foreclosure, or I'm sorry, bankrupting, going into bankruptcy, pardon me, and everyone's blaming COVID. I'm going to tell you, this is just euthanasia. I mean, if you didn't think JCPenney's was going out of business, you're out of your mind. If you didn't think some of these other ones, I mean, they're letting the catastrophe take an excuse for what we all knew. I own Amazon. I own Alibaba. I own all the stocks we're going to talk about here. I own JD.com. JD.com I actually like better than Alibaba, but I'm up 80% in it. its price to earnings ratio is 345. So it's, even though it's $55 a share versus 219, it's way more expensive than this. Alibaba is the cheapest. They are more than just an e-commerce online. They're a media company. They're everything you can think of based out of China. They are the Chinese version of Amazon. Okay? Absolutely can't miss. Jack Ma, the former math teacher, founded the company. They're great. Price is $219. Year range is $1.47 to $2.31. A little bit high on that. They're making $3.50 a share. They're making $3.50 a share. This is a large cap growth with a market cap at $587 billion. Massive, massive company. Amazon is about $1 trillion, so this is about half the size of Amazon. That's big. Price to earnings is 26. That's fine. Anything under 30, I love. I love. Doesn't mean I won't buy anything that's not under 30, but I love it. But as a difference, you can see here, 9 to 26. Return on equity, 28.54. Very good. Very good. Doesn't pay a dividend. A lot of growth stocks aren't going to do that, and that's fine. We want them investing their money in constantly growth to get this up. We want that to appreciate. The word I could not think of when I said tourism, media conglomerate, biotech, and e-commerce online slash basically international conglomerate was diversification. I fumbled over it. I was thinking I couldn't. We are diversified. We don't have any overlap here. I mean, yes, they probably have some Chinese media companies that do not compete with Disney, so we're okay here. So those are the three blue chippers that today you buy. Unless today's Saturday or Sunday, then buy it on Monday. You can just buy them, flat out. You don't have to market time it, buy them, hold them, never sell them. Next, we're going to talk about three companies on the come. The first company on the come is Redfin, ticker RDFN. Redfin, you probably heard of, is an online real estate company. It's a fintech company. You know, for 40 years, realtors are going to hate me, but some of them work their ass off. Some of them get paid 5 to 6% commission if they're representing both parties to open up the door for people to check out houses. I always thought that system was bad. When I buy properties, I was always like, man, I'm paying commissions everywhere. Well, they also own title companies as well. Everything can be online. I love them. I've owned them since $12. Price is $26.13. I've made 60% on them, so they've run. More room to run. Their CEO was just on CNBC. I love what he's saying. You know, real estate's been beat up because of COVID, so think about what it's going to do when they pop back. Year range, 963 to 33. We're in the high range of that. It's not making money. The reason it's popped high, though, it's because its last quarterly earnings, they lost less than expected. We like that. They're getting closer to earning money. If we look at this, we see its market cap is $2.56 billion. Small cap. I said anything under $2 billion is close enough. It's a small growth company. We said real estate and fintech. It averages 2 million shares a day. So that's way less than a lot of these big ones. That's the other reason I put that. Have key points. The next company, my favorite one on the list today. As I was going through it today, I was like, I have to buy more tomorrow. I absolutely have to buy more tomorrow. I can't believe that it's this undervalued. So it's KeyCorp, owner of KeyBank. It's the holding company. KeyCorp is a mid-range bank that has trust company, insurance, asset management, investment banking, loans for everything from real estate to technology, what have you. Anything that the big wirehouses do, they do. They're just smaller. I like that. They're based in Cleveland. I have, you know, ridiculous respect for the city of Cleveland. I love it. It's a hardworking town. It's a hardworking company. I love it. Price is $10.21. The year range is $7.45 to 20. So it's way low. We like that. Banks are getting their asses kicked. They're not making any money. They can't be open. They're not doing anything. So because they do it all, they're getting killed. I'm not saying you don't own the big ones, but this is a gem. This is a diamond in the rough. You've got 100 ways to make money on this. The fact that it's a profitable company is going to roll. The fact that it could get bought someday. These mid-level banks are absolutely great to own if they're run right. This one's run terrific. Earnings per share makes it $1.36 even in a tough time. It's considered a mid-cap value because banks, value, makes money, pays dividend, and middle of the road. Why? Its market cap is 9.9, right on that $10 billion threshold. So that's why it's a medium-sized company, right? PE 7.49. I mean, I don't know what else to say. You know, certain companies have a 7 PE and they're going you know, you just can feel they're going out of business. I mean, I remember when Blockbuster, you know, the founder of Blockbuster was buying everything he could to try to privatize it, to keep it going, and you just felt bad. You just knew it was going to happen. Just like these brick and mortar retails, I see it coming. It's like, just let them be euthanized because, you know, COVID is just going to have a quicker death. Shareholders would have gotten wrecked for the next 3 to 5 years before they file. 7.49, absolutely fantastic. Return on equity, 9%. Okay, not ridiculously high, but again, it's a bank in COVID. The dividend is 6.91%. You're saying, well, of course it is, Rick. The percentage is this because it's only 10 bucks. I don't care. It's got a 7 PE. Every tool under the sun in terms of what a bank's supposed to do, but it doesn't get into massive deals. It doesn't get dirty. It doesn't have CMOs or ladder mortgage-backed securities. Does everything right. Absolutely love it. My favorite out of all of these. Third one, Lam Research, ticker LRCX, semiconductor company, semiconductor components. Been one of my favorites for probably 15 years. 5G coming, and it's coming. I love this debate about what's it going to do and how great it's going to be, what have you. I own Skyworks. I own, you know, other companies that are involved. Lam Research, $261 a share. You're like, wow, that's okay. That's pretty expensive. Well, we'll talk about that in a second. Its year range is $1.71 to $344, so essentially right in the middle. Earnings per share, 13.89. I like that. I like that. Market cap is $37 billion. So again, we're in the large cap, but we're small in that large cap. We're not mega cap here. We're not too big, right? PE is 18.8. 18.8. So its price is more expensive than Alibaba, but it's cheaper. Way cheaper. Doesn't resonate to a lot of people, but I'm telling you, it's cheaper. It's got more room to run. Return on equity is 47. Aha, salty. Love it. Dividend yield is 1.79. So here we have a company in a growth space that makes almost 14 bucks a share. Its PE is ridiculously good and still pays a dividend, trading right in the middle of its range. Are you kidding me? You know, this is kind of no frills tonight. 3 stalwarts, Disney, AbbVie, Baba. Buy them, don't trade them. If they go down, buy more. That's how you make money. You make money on the buy, never on the sell. Redfin, KeyCorp, and Lam Research. Those are 3 that, I mean, they're not all new, but they would be considered small cap, mid cap, or just under the large cap. Redfin is the most frontier, but hey, this is where technology is going. I had one of my dear friends owned Amazon when he was in college. He was in a car accident. He got a settlement. He bought a bunch of GE and a bunch of Amazon at $5. He sold it when it went down to 3 because he wanted to have a huge part at the end of the year. Now this guy is wildly successful, but I'm going to tell you, because back then Amazon was this dinky online bookstore that wasn't making any money. So 5 to 3, thought it was going to go to 0. Well, guess what? It didn't. But you don't know that. Redfin, I think, is, I'm not saying it's the next Amazon, but it's here to stay. It's a fantastic company. Got to give a shout out to all the countries that have been calling in, you know, or been dialing in, thanking me. I've had people from Poland, people from Mexico, people from Portugal, people from Spain, people from Canada, India, Saudi Arabia, people thanking me for my help, especially on the 401k, which is awesome. I've had some gamers that have been on. One of them told me to fuck off, which was, hey, we need all kinds. So, put messages in there. If I said anything, like and subscribe. Here you can see all the other ways to look for content, and I hope you had a little bit of fun tonight and saw the stocks that I'm picking for now. I wasn't going to do it, but because you asked, I did, and I'll stick to my guns, and I own all these, and I'll continue to buy them. See you next time.